let's start with a high level overview of where our world is headed, how a monetary reset is happening. What do you mean by that? What does that look like?
Well, I think I'd start with the 30,000 foot observation that, we are having a debt crisis, which means a currency crisis. The ripple effects of debt affect, and you look at the facts of equities and bonds, the recession discussion, the currency issues, the inflation issues, the deflation debate, labor markets, oil, all of these things, and of course, gold trigger off or flow down from this debt crisis, this unprecedented reality. And, good journalism is often very boring, just like hard economics are often very boring. But these numbers that we're looking at, and, keep it simple, stupid, because I keep saying the simple is very stupid and the stupid is very simple. When you have 120% plus debt to GDP at the home of the world reserve currency, a 7% deficit to GDP, when you've got Congressional Budget Office pushing for another 20 trillion of treasury issuance in the next 10 years, when you've got a net international investment position that's negative 65, 212 trillion in unfunded liabilities and 190 trillion in assets. That's a banana republic balance sheet. When our Fed balance sheet has gone from 17 trillion to 34 trillion in a decade, when we have $1 trillion in new deficits every 100 days, these things are extraordinary. And although they may seem like numbers on a screen or just data points that we throw out there, they become abstractions. Implications of these unprecedented debt levels, these unsustainable debt levels, obviously affect the risk asset markets. Obviously, they affect the credit markets and bond markets, in particular, currency markets, and all of that affects the US dollar. And of course, that impacts precious metals in general and gold and silver in particular. So that's my opening thought. The debt is the key stone in the pond, and the ripple effects are everywhere in the macro scene. It's happening in real time right now. The evidence is all around us. I mean, many of your viewers are pretty sophisticated in understanding debt and currency markets and precious metals and rates and yields. But I look at it again, what's happening in real time with central banks, what's happening in terms of real time with the oil trade, what's happening in real time with de-dollarization. These were sensational themes just a couple of years ago, and now they're happening at rapid pace. You can't deny the simple fact that since 2014, the central banks have been dumping US Treasuries net and stacking physical gold net. You can't deny that the de-dollarization theme, which became obvious from day one of the sanctions when you weaponized the world reserve currency, was going to be a seismic shift in currency markets and debt markets. That's been happening faster than even I and Grant Williams and Jim Rickards and John probably could have predicted 2 years ago. But the writing was on the wall when you weaponize the world reserve currency. And what we're seeing now in the oil trade with the petrodollar, what we're seeing on the COMEX, there are seismic shifts happening already. 20% of the petrodollar, basically the oil trade last year outside of the US dollar, when you have 45 BRICS, 45 countries, and the BRICS plus countries rising in membership, including Saudi Arabia and the UAE. When you have 45 countries doing trade settlements outside of the US dollar, when you see what's happening with the ruble and the yuan and what they're doing in the oil trade, what even Japan is doing now outside of the petrodollar, these are massive implications on the US dollar. When you take away that synthetic demand from the petrodollar, when you look at what's happening in the COMEX market, the deliveries going out day by day, all of these things are massive. And when you look at central banks dumping US Treasuries consistently and stacking physical gold at record levels, these are massive changes right now. You could argue that we're already in real time seeing changes. And when you could argue that when the IMF was talking about CBDC in 2020, at the height of the COVID crisis, and what's happening now with the number of countries adopting it or going towards it, or what the BIS is doing, there are major changes happening right now. When it becomes an actual uh-oh moment in the risk asset markets, we can talk about those markets too. But I would say that we're already seeing things that aren't sensational. They're actual, and they may have seemed sensational 2 years ago. But today, the list is long and distinguished. And I think just what's happening in the COMEX and the petrodollar, or what's happening with central bank stacking of physical gold, is already extraordinary.
So I'll just present a chart and some figures for the audience here. This is a chart showing the federal deficit level or surplus. It's a percentage of GDP. It's currently, according to the St. Louis Fed, it's currently at negative 6.1%, which is to say that the deficit level is currently at 6% of the national GDP. The last time it was this high was 2020 for a very brief period of time during the pandemic. And before that, it was 2008. And we haven't had a deficit this wide as a percentage of GDP before 2008 since World War II. Now, I would argue, just looking at recent data, that we've had a deficit, a substantial deficit, ever since the great financial crisis of 2008. And what preceded after 2009 was the longest bull rally in American stock history. And so it doesn't really matter for markets whether or not the economy is in a deficit or a surplus. How would you argue or challenge that, or even agree with that?
If the Fed is hawkish or dovish, the markets are bearish or bullish. I joked often, and it's a cryptic joke, that you could literally have a nuclear bomb go off in Cleveland. It wouldn't send the markets down if the Fed wants to print money, or if the Fed wants to support or accommodate the markets. And that's through interest rate policy and balance sheet experiments. They've got two revolvers at the Fed, the balance sheet and the interest rates. And, if we can centralize capitalism, I think capitalism died in 1913 in general, and probably 2008 in particular, when the Fed stepped in and took away free price discovery completely to support the bond market. The real mandate of the Fed isn't inflation and employment. It's supporting the US Treasury market to keep the yields under control. And they will at some point have to make a decision between supporting the system and sacrificing the currency. Technically, you could nationalize the S&P, which is really just a tech ETF right now. We get into the details of the NASDAQ and the S&P. But you can effectively, just through the carrot of promised rate cuts or eventual inevitable rate cuts, I see, and more QE, which I think is inevitable, the policies of 2018 that led to super QE in 2020. But if you're going to create synthetic liquidity, you're going to debase the currency to save the system, not just the bond market, but this 401k, this nationalized 401k, which is the S&P. So technically you can do that, but be careful what you ask for, because you'll be measuring your returns in a debased dollar. Because the markets, yes, technically modern monetary theory works. You can keep the markets from ever having a recession that can't be repurchased, or that is a dip that can't be reaccommodated, but you'll do that at the expense of your currency. It'll be devastating. So you're measuring your returns with a currency that's debased, and you're also going to inevitably lead to inflation, because QE is inherently inflationary, and your real return, your inflation adjusted return, will be comical when you look at the type of actual inflation that will be subsequent to the type of accommodation needed to keep these Pavlovian markets alive. As long as the Fed, and it will inevitably resort to, I think the only reason it's raising rates now is it will have something to lower, and the only reason it's tightening its balance sheet is they'll have something to fatten, because it inevitably, the system requires lower rates. It requires artificial support for the bond market, not natural supply and demand. Foreigners aren't coming to our auctions. Foreign central banks aren't buying our IOUs. Uncle Sam will do it through the Fed at the expense of the currency and at the expense of an inflation number that we all know is misreported, underreported, and about to get much, much higher. In the interim, you can have disinflationary forces when you raise interest rates, the Fed funds rates, from 0 to 5.75% in a short period of time. That can be disinflationary. An inevitable market implosion can be disinflationary, but the end game, since there's no natural buyers of our debt and we live on debt, is going to be QE to the moon and ultimately a higher inflation market, regardless of how the BLS reports it.